Today on Your Money, we're talking about generational wealth, how to pass money on to your kids and grandkids, how to invest and plan for the future, and how financial advisors are trying to close the racial gap so everyone can share the wealth. It's all coming up next. Welcome to Your Money. I'm your host, Gordon Severson. Generational wealth is a big buzz phrase in financial circles right now, with more people hoping to pass something on to the next generation. So today I'm giving you a how-to guide to get your finances on track so you can hopefully have enough money left over to pay it forward. And it all starts with how you think, your mindset. So many people are only focused on today, but to build generational wealth, advisors say you need to focus on tomorrow, seeing what your money could become if you give it time to grow. Here's Ken McCoy.
From a fundamental level, financial planning is a means of thinking about the future as opposed to just living for today.
The old saying goes, don't put off till tomorrow what you can do today.
I think in there's a balance between living for today and having things that allow you to live a comfortable life and also setting money aside.
October is Financial Planning Month, and CEO of Family Financial, Tammy Trenta, helps us understand the importance.
We learn so much of our financial habits from our parents, and that could be good or bad.
And getting started can be as simple as getting your first check.
When we talk about the future, I use the term pay yourself, right? It's investing in yourself. 50% of it should go to meet your needs, 30% of it should meet your wants, and 20% of it should be investing in yourself for the long term.
And it wouldn't be a Money Matters segment without talking about savings.
Things always change, and so you need to be prepared for unexpected things to happen. And so from a fundamental level, you want to, we'll call it an emergency savings fund, but it's money that is liquid, that's available to you if you need it.
Wealth is generational, and getting your kids to understand money early may help them as they progress on their financial journey.
We're using Venmo, we're using cashless apps, we're using credit cards, and so it becomes harder to allow children to understand the value of money. But there are some psychological fundamental things that you can do when they're young. So if, let's say they get a set amount of money for allowance, they can spend it on a toy, or they could spend it on something more meaningful that they have to wait a little bit for. And just that concept of delayed versus immediate helps them to understand the concept of saving for retirement and making wise investment choices.
I like her viewpoint here. Building generational wealth isn't just about passing money on to your kids, it's teaching them how to manage their money. I love this because it's like that old saying goes, you can give someone a fish and feed them for a day, or teach them how to fish and feed them for a lifetime. It's the same thing with money. If you give them money when you die, that money will run out. But if you teach them how to manage their money, hopefully these lessons will stick around forever. Remember, it's a journey, and it's one you don't have to walk alone. There are likely groups in your community who can help you get started. Check out this story from Candace Red in Sacramento.
Delmika Wyatt is focused on building generational wealth.
It was the constant struggle of trying to figure out how to make ends meet for basic needs, right?
It's why she started talking with her family about finances.
We actually took a look at our bills and budgeting and found out, wait a minute, there's more money here than we thought. The difference is we have to learn to tell our money where to go instead of our money just going.
She gained success after creating a family budget and sticking to it.
We went from an apartment with our children to buying our first home here in Del Paso Heights.
According to the Federal Reserve Survey on Consumer Finances, Black households have the lowest median net worth at $45,000. Hispanic families have $62,000, white families $285,000, and Asian families $536,000.
So we fight here at Urban League to make sure something is done about it.
Delmika works with the Greater Sacramento Urban League to help others become financially fit.
We are a place that is here for our community.
The Greater Sacramento Urban League partnered with Golden One Credit Union to offer free financial wellness workshops.
It's really the community's chance to have one-on-one help with a certified financial coach.
Daniela Alvarado helps lead the workshops and says financial education is key.
We cover everything from different checking and savings accounts, what a credit union is, what a bank is, those differences, and different insurance levels.
It's very important to budget and to track your income and track your expenses.
David Fontaine is a financial expert and wrote this book.
It's called The Black Financial Literacy and Wealth Building Bible. And what it speaks on is how to grow your wealth, how to make money, talks about how to keep your money, and it talks about how to safely pass on your money to future generations.
He says one of the most important rules to finances is
living below your means.
David goes on to explain that
investing and saving takes place over time. Let's get at it and do it. What we can in our individual communities and our individual families. That is so important, and we can do it.
Besides community groups, there are so many great books out there to help you get started on your financial journey. Some classics include Rich Dad, Poor Dad, The Millionaire Next Door, and I Will Teach You to Be Rich. You can also reach out to a financial advisor for some advice. I recently sat down with one of our local advisors to have a deeper conversation about generational wealth. One of the big buzz phrases in money these days is generational wealth. It's a concept that a lot of people associate with the super rich, the billionaires of the world. But we're going to talk about how you can create generational wealth for your family, your kids and grandkids down the road. And to help us talk about this, I've got Ryan Brown from Northwestern Mutual. He's a financial advisor. Thank you so much for coming on the show.
Good to be here.
So what is this whole concept of generational wealth?
So generational wealth is being able to pass along what you have onto the next generation, right? So for many folks, it's money. For many folks, it's assets such as real estate, investments, things of that nature.
And a lot of people think that it's not something that a middle-class person or a lower-class person can do. It's only for the super rich, but you can potentially set things up for your kids and grandkids someday.
100%. There are many different ways of being able to pass on wealth as you define it, right, to the next generation, whether that's I own a house and I want to make sure that my kid gets that house, or I own a rental property. I want to make sure that my kid, when they become adults, they pass it on to their kids. And there's many different ways and shapes or forms that can be created through having a financial plan to make sure that that happens. And I think the most important thing is that that happens in a tax efficient way.
And I'm assuming that passing on generational wealth can really affect the success of the next generation. Like, how can that play a role in the kids and grandkids on the road?
Yeah, I mean, I would think about it if you have seen your parents, grandparents have success, you're more likely to strive for that success. If you are starting here versus here, you're going to have a better opportunity for that success. And the way I always like to look at it is, I grew up in a place where my mom sacrificed pretty much everything so that I could be in the place where I'm at today. She worked 2 jobs, single parent household, so that I could be exposed to an opportunity that was bigger than what she had had. Mm-hmm. And so being able to be exposed to positive influences, positive exhibitions of success is going to set you off to a higher trajectory. And what does that look like? It means coming out of college without debt. It means, if your parents pass away and they've put together a financial plan that allows you to get assets as opposed to getting liabilities, right? And having it be not a headache, but you know what I mean? Like if you take on debt and you have to worry about your parents' estate and it's in arrears, as opposed to, hey, here's a house that's free and clear of any debt, that's going to set you off to a greater trajectory. And by having a plan by design is going to allow you to live that way as opposed to by default.
Yeah, I love how you brought up, college debt, and that's a big thing because, just imagine, like student A graduates at 22 years old and has no debt. Mm-hmm. Student B graduates with, $40,000, $50,000, $100,000 in debt, and see those financial situations 100%. Play out. It's a very different situation.
It's a massive difference. It's like without question, I I definitely look at debt as good debt versus bad debt, right? There's good debt. Student loan debt can be good debt if it allowed you to get the career that you have, the income that you have. But certainly if you're burdened by $100,000 in student loan debt and you've got to pay $1,000 a month to that other person who's, even maybe making less money than you, has a lesser income or higher lifestyle than you, they've got that $1,000 to invest. So those trajectories are completely different. And I personally, as it relates to my kids, I want them to understand, why are they going to college? Why are they, if they're going to go, why are they taking on this debt? And if they're taking on the debt, making sure that the income that they get afterwards is commensurate with the debt that they're taking on, right? There's multiple ways you can fund education, right? Take out loans, grants, scholarships, work study, all that stuff.
And so you can create generational wealth, not just with money, but if you don't have the means, you can start working with your kids early to try to identify scholarships, try to find work for them that they can do, part-time job. But you can create generational wealth in other ways besides just giving someone money if you don't have that ability. Yeah,
and I think there's ways to non-monetarily create education, right? To create mindset, to create good habits in the form of saving money, having a plan, living within your means. Because I think the greatest way you can pass generational wealth is by having wealth to pass along. And to do that, you must live within your means. So I know that, my mom taught me nothing about money. And so I had to learn that at a later age as to what was my relationship with money and what did I want to do to pass that on to my kids. So I see a lot of my clients, a lot of parents saving for their kids early, having them learn what a Roth IRA is, right? Because you don't have to be 22 years old with a full-time job to have a Roth IRA. You can have a Roth IRA for my son's 4 years old. He's had a Roth IRA for 3 years. Being able to teach those little bits and pieces along the way to teach them mindset, different tactics, different strategies is also a way of passing on wealth to the next generation.
And one thing a lot of people are wondering about is if they are lucky enough to have some generational wealth, say grandma passes away and brings a house into the equation. How does someone even approach something like that? Because I know that's, it's emotional. You're dealing with the loss of a loved one, but then also these big potentially money decisions that you haven't had to make before. And I'm sure there are really good ways to handle that with tax strategies and things like that. How does someone approach that?
So my first thing would be to get out in front of that before grandma passes away. Make sure that you've had the conversation with grandma, had the conversation with mom around what is your estate plan? What do you plan on leaving to whomever you want to leave it to? And make sure that they have an estate plan in place that allows them to live by design and not by default. If you live by design, you're more likely to pass along to whom you want to pass it on to, what you want to pass along, when you want to pass it along, and you're allowed to keep it in the family as opposed to giving it to Uncle Sam. That's what I call living by design. Living by default is saying whatever happens, happens. When that happens, you lose money on taxes, you lose money through probate. So the first step, have a plan. The second step is work with an estate planning attorney to create that plan in paperwork in a legal form so that things get transferred in an efficient way. The emotional part is if you have not done that, right? It's like, what do I do next? The thing I would say is have the professional step in. Estate planning attorney, financial advisor, they can help that transition and then help you learn from the mistakes that were made prior to you receiving that asset. And obviously, always enlist the professionals.
Because when you're planning on the front end, you have all these options, all these choices. But if you don't, your choices are more limited. Yeah. All of a sudden,
if you have choices.
If you have choices. Yeah, there's this house all of a sudden, and you might have 3, 4 siblings, and it's like, how do you even begin to deal with something like that?
Yep.
And so that's a good advice to be planning for that and have those awkward conversations that are very difficult to have.
It is much, for me, it's much better that you have a conversation and you don't need what happens than to not have the conversation and you do need it, but you don't have a plan. Right. So having those conversations, making sure that if there are bumps in the road, premature death, illness, injury, that you have a plan in place that protects those involved.
And we're talking about generational wealth, and it's one of those things where, as a society, we're trying to find ways to make everyone have opportunities to succeed, and oftentimes generational wealth gives people more opportunities. What do you think we need to do as a society when it comes to generational wealth to make it more equitable so that everyone can have that ability to strive for generational wealth for their family?
Yeah, I mean, that may be above my pay grade to be able to answer that question fully. But as I shared before, grew up single parent home. I was lucky enough to be exposed to somewhat of an environment where there was a higher ceiling. I know that everyone in this world does not have that opportunity, right? Where you go out and you see the people who are succeeding are not the same level of success that you would see, like, as a perspective in the outside world. For example, after graduating college, I lived in Greenwich, Connecticut for 5 years. Greenwich, Connecticut, as you may or may not know, is one of the wealthiest places in this country. The kids that grew up in that environment, their ceiling was infinite, right? So everything that they saw was like, I can be this level of success, meaning owning companies, millionaires, things like that. So what I would say is what I want to do is be able to provide and show people what is possible on that end, is that you don't have to actually have that upbringing to be able to move into the direction that you want, and hopefully doing that by my role as a financial advisor and also as a mentor and mentoring the Big Brothers Big Sisters here in Minneapolis, is that I think the way to build generational wealth is seeing that it's possible, is to see that it is possible to achieve that by hard work and conscious thinking.
And starting small, even just a little bit, setting aside each week or month, it can snowball over many years.
100%. Yeah, I mean, there's no wealth to give if you don't save money. So it's having a plan, being long-term thinking in nature, making sure you're living within your means, and then when you are doing things on a day-to-day, month-to-month basis to achieve that long-term goal, then you have the opportunity to pass that along to someone else, both financially and non-monetarily as well.
Great. Well, great advice. I appreciate you coming on the show.
Good to be here. Thank you.
Coming up after the break, how many parents out there are still supporting their adult children with their finances? The answer might surprise you, so stay tuned. Welcome back. As I mentioned earlier, a great way to build generational wealth is by teaching your kids the value of money and helping them become more independent. That's not the case for about half of the young adults out there right now, according to a new survey from Savings.com. It suggests that nearly 50% of the parents out there are still financially supporting their adult children. Jane Monreal broke down the highlights of the survey. Take a look.
Many parents want to help their children when they are in a pinch, but this new study shows some parents are spending up to $1,000 a month on their adult children still living at home. The most common generation of young adults to receive parental help is Generation Z, the youngest adult generation. The Savings.com study shows parents are not just helping their kids when they're in a financial pinch. Some of them are even funding their lavish vacations, even paying off credit card debt. Savings.com found 58% of parents have sacrificed their own financial security for the sake of their adult children. And that study shows working parents contribute 2.4 times more to support their adult children than they do their own retirement accounts each month. So what exactly are parents paying for? Savings.com says each situation's unique, but the most common costs that parents are covering for their adult children, their basics, groceries, rent, and cell phones. The study shows parents helping their adult Gen Z kids tend to pay 3 of their bills each month, while millennial children are usually getting 1 bill paid, thanks to mom and dad.
That's not to say that you should cut off your kids completely. There are some advantages to helping your kids with their money. Say with insurance. If you can keep your adult child on your insurance as a dependent, you can save your family a lot of money, so they don't have to go and find their own policy. According to healthcare.gov, adult children can stay on their parents' insurance until they're 26 years old. Another great way to build generational wealth is life insurance. Chris Radcliffe has some great advice on how life insurance can be a great option for young adults who are just getting started and older adults who don't want to leave their family with a mountain of debt.
Maybe you get it through your job, but you should have between 5 and 10 times your annual salary in life insurance to make sure that your family could overcome losing you, and term policies will be the most cost effective.
Term insurance right now is, it's cheap. You can get a lot of it, but usually it's, it runs out, and when it runs out, you're going to be a lot older, and it's going to be a lot more expensive to maintain a policy if you so choose so.
Whole life insurance will be more like an investment, and it will cost you much more each month, but it will be there upon your death.
On the other side of the aisle, where whole life is purely, it's for you when you pass away, but usually it's a legacy play. Now, I can dive into the woods and tell you how a lot of people use whole life as far as, the whole banking concept has become extremely popular thanks to TikTok and Instagram and all these things. But they don't tell you the whole story a lot of times. You have to fund those things a certain way to get that benefit. But whole life is usually a benefit play. Whole life is popular with kids, young kids.
Remember, not many people die young, meaning like most insurance, it's only there if your family needed it. And like car insurance, you hope that you never need it.
I honestly think, I think the stat is 99% of term policies don't pay out, whether they either outlive them or, at some point in time, they'll stop paying for it along the way. But then that's where the investing the rest comes in. You kind of invest in, vehicles such as Roth IRAs, brokerage accounts, things like that. And
Rojo kept emphasizing for me how inexpensive term life insurance is for a 20 or a 30-year plan for someone in their 20s or 30s.
But then you're on the other side where you've got whole life, which, $100,000 whole life policy may cost you $200, where a $100,000 term policy may only cost you $10 a month.
And if you are unsure about how much you should be spending on insurance, you really should consult a financial advisor and come up with a plan.
But, make sure you're doing what's best for you and your financial picture. That's where guys like myself come in. But, like I said, young people, my advice is if you're going to do anything insurance-wise, get you some term. It's cheap. It won't break the bank. And then you're protected. And then as you grow and you accumulate things, the budget becomes bigger. Maybe look at doing some kind of permanent policy. But start off with the simple stuff, term. I know that's kind of what I preach. If you don't want to go the complicated route, let's get you some term insurance, and then we can grow from there.
With life insurance, it's important to identify your goals. What are you hoping to accomplish with that money? For my wife and I, we wanted to make sure we had enough money to get our kids through high school if we don't have both of our incomes. We sat down with a professional and figured out the numbers. But your goals may be different. Once you identify them, then you can create a plan that works for you. There's still more to come here on Your Money. You stayed with me this far. You want to see how it all ends, right? So stay tuned. Welcome back, and thank you for sticking with me on this topic of generational wealth. Two of the most uncomfortable topics to talk about are death and money, and today I sort of put them together, so I know it's not easy. With death and money, people typically think about wills, and while they're important, it's also important to declare a beneficiary in all of your accounts. Jason Wheeler explains why.
We are making our way down the death checklist, aka the life checklist, because that is cheerier and because this stuff needs to be completed while we're still living. We're finally getting to wills next time, because those always get put off. And really because even if we have a will, and certainly if we don't, we need to pay attention to naming beneficiaries on our accounts. We talked about this last summer, and hopefully you got it done, but if you didn't, and even if you did, there is more to discuss here. Life insurance, IRAs, CDs, 401ks, checking, savings, and brokerage accounts. All of them have forms for you to select beneficiaries. Those are the people for each account who you want to leave all or part of the account to when you die. Now, usually you can choose one or multiple primary beneficiaries and the percentage each one would get. Now, in case your primary beneficiaries are also deceased when you die, some of these accounts also allow for you to choose a contingent backup beneficiary and the percentages each one of those would get. Now, depending on the account type, a beneficiary can also be called a payable on death or transferable on death designee. Some banks require you to make that selection in person at their branches. Others allow you to do this online. Now, only about a third of people surveyed realized that the person named as the beneficiary or the payable or transferable on death designee directly gets the money when they die, but they do. Generally, they just present their ID and your death certificate, and the account becomes theirs right away. It doesn't take months or even years because it bypasses the lengthy process of probate, which is when a court oversees the distribution of your assets. So a caution here, this is powerful stuff. Even if you have a will and it says you want to leave such and such account to so-and-so, but you name what's-his-face as the beneficiary on that actual account, the beneficiary designation usually prevails over the will. So what's-his-face would get it. Make sure that the names are spelled exactly right, and make sure this is who you really want to leave the money to, because maybe you listed your husband as the beneficiary, who then became your ex-husband, and you don't want your ex to get your assets. So update these. Maybe make that the day before your birthday chore every year so you remember it.
And don't be afraid to reach out for help if you're confused about naming a beneficiary or setting up a will. There are experts out there who specialize in wills and end-of-life planning who can help you make a plan. So let's end today on a positive note. I have a new YouTube channel here at Your Money. Check us out at youtube.com/yourmoneyplus. You can binge watch all of our episodes and find exclusive clips and interviews. So check it out. Until next time, I'm Gordon Severson, helping you save, spend, and invest your money wisely. I'll see you next time.